Welcome everyone to the Oregon Realtors Forms Updates. This is the 2026-2 edition of the Forms Updates. By way of explaining what that means is we have updates that we do and we label them with the year and the edition of the updates that we're doing, how many, what chunk of the year we've been updating it. Typically, our goal from now on, if we can hold steady to this as much as possible, we will update on January 1st and July 1st. Those are the two updates that we'll do. So it'll be the first set of updates will happen January 1. The second set of updates will happen July 1. And so -1 will be the first 6 months, -2 will be the next 6 months. That should be the goal from this point onwards. We're trying to create internal processes so that happens every single time. Now, there may be changes that happen in the intervening months that require us to do a third version, like a special session change to the forms. Those will be rare. If they do happen, it'll be in response to, for instance, like a major lawsuit or to a substantial shift in the law or some major directive that comes from NAR, something like that. It would have to be something that is radically changing the industry for us to deviate and say this is something that has to happen in real time right now. Otherwise, should be January 1st, July 1st. And the ones we're going to talk about here are the ones that go live on July 1st of this year. Now, our form updates come from several locations. They come from user comments, they come from forms forums, they come from principal broker forums, they come from task force input, and they come from a fair amount of attorney review. All of those are viable sources. All of them are available as kind of the resources we draw upon to make changes to the forms. User comments can always be delivered at any time. forms@oregonrealtors.org is the email. If you have updates or questions or requests or commentary, forms@oregonrealtors.org. It's the way that we can make changes to the forms. I'll talk about that as this training goes on. There are a handful of areas where the suggestion to the form it was something that was not done, and I'll point those out as well. So we just wanted people to know your comments are listened to and they are something that is discussed and considered. Some are changes that are made, some are not. It just depends. We have forms forums at our conventions twice a year when we do our spring and our fall governance conventions. We also have a forum where we get a whole bunch of people in a room. We ask them what's going well and what's not going well, and they give us various commentary. That generally will trigger 1 or 2 changes to the forms each year. As they say, principal brokers will say something like, this isn't working for me when the form looks like the following thing, I need those changed, and that becomes integrated into our list of possible changes into the future. We do principal broker forums periodically. The principal broker forums are essentially local associations and larger brokerages will oftentimes do principal broker gatherings where they have a fair number of questions about topics of law, topics of forms, topics in general, and those sometimes inform changes to the forms as well. We have a forms task force comprised of principal brokers from around the state that practice with a broad swath of specialties. Some are buyer side, some are seller side, some do specialty transaction processes, some of them run large brokerages and do a ton of supervision, some of them are on the ground and doing a whole lot of actual brokering. It essentially guides the decisions that are made on the forms themselves. So it's not just attorneys and it's not just commentary. It's also a task force of specialists and professionals that do this a lot, that have strong opinions about forms. And the last one is attorney review. The attorneys look over the forms all the time. We try and make changes where necessary to keep it compliant with the law and to keep it up to date as necessary, and to just keep it compliant as much as possible with the various changes that happen at a federal level as well. As for what we're going to talk about today, I've broken it into 2 broad categories: forms with major updates and forms with minor updates. Major updates are new forms or things that have radically undergone change. Some like sea change movement has happened. This year, or this set of updates, it's all new forms. We're going to talk about an insurance contingency addendum that was requested, a multiple offer notice, a listing agreement addendum, and a transfer agreement. Those are 4 new forms that have been added to the library. Forms with minor changes, little fiddly tweaks to the forms. Usually it's 1 provision that's changed, or 1 sentence that is changed, or 1 provision that is like a word or 2 that are shifted. Those ones are much more comprehensive. Many parts of the library have undergone minor tweaking. All of the sales agreements have minor tweaking. The invitation to escalate, the counteroffers have had minor tweaks. The lead-based hazard addendum, the well and septic stuff, the contingent obligation to sell, the release of contingencies document, the association addendum, delivery and receipt of association documents, a sister document to the association addendum, commercial assignment of lease, exclusive listing agreement, buyer rep agreement, real estate teams additional names. We have an add-on document for that now, required teams disclosure, and that has had a change added to it as well as the EPA-led pamphlet. And when all that is over, I'll also go over some miscellaneous shifts. We had one form we took out of the library. We have a couple of things that there were comments from the membership or requests for change, and we just weren't able to, they weren't things that the task force thought were valid or viable changes, and they were jettisoned, they were rejected changes. I still want to talk about those though, because it is worth the discussion to understand what people did, or like what changes happened and what changes didn't happen, and also to find out why those changes didn't happen. So that'll be the end part of this training, is to talk about the things that were not happening, the dreams ungiven in the forms library. To start with, though, we'll begin with the insurance contingency addendum. This is a new form. It's form 2.24 in the library. 2.24 looks like this, and we'll talk about it more comprehensively as we go. Basically, it establishes an insurance contingency, exactly as it sounds. It's right on the box. The insurance contingency itself begins basically saying the sales agreement is contingent upon the buyer getting a binder, an insurance binder of some sort. Now, the insurance binder, if that's not available, then makes this, it's contingent upon the buyer actually getting the insurance policy itself. But generally speaking, you're probably going to get an insurance binder where the company binds, it's not like the physical like 3-ring binder. It's the insurance company binding itself to temporarily committing to offering the insurance policy as they have agreed upon. So they would make this contingency subject to the sales agreement, subject to getting the insurance company's say so that they are going to provide the policy you have requested. If the buyer puts this on their sales agreement in some way, they have to apply for that insurance contingency within a certain number of days after mutual acceptance. It should be something where the buyer has a fire lit under them so that they then start getting that insurance policy post haste as quickly as they can, because it is something that might take time. Failure to apply for the insurance coverage within the time frame provided will be treated as the buyer releasing the insurance contingency. If you, the buyer, say, seller, I don't want to have to buy your house unless I get a very specific insurance policy, and then you go on vacation for 3 weeks and don't even start on the insurance policy until several weeks into your transaction, the insurance contingency does not apply anymore. Generally speaking, buyer, you need to start working on that insurance thing real quick, soon after you've started your mutual acceptance. Pick up the phone, call the insurance company. That is the process of starting the insurance process, beginning the application. The buyer will have until a specific date to obtain the insurance coverage, either the binder or the actual policy if a binder is not available. That date is treated much in the same way as like an inspection contingency or a due diligence contingency, where it is a window that closes. You have until that date to fulfill the contingency. If that date passes and you have not fulfilled the contingency, your right of termination as a buyer falls away. So you, the buyer, are given a special right of termination during this window where you can say, I couldn't get the insurance, just wasn't working, I can't do this transaction because I want to make sure that I have wildfire insurance because this is a wildfire prone region and it scares me. And if you get to the end of that date and you haven't terminated, you no longer have a termination right. So it is contingent, but the termination right is only that time frame, that short time frame of the ability to get that policy. This is a separate document, Tammy Sue. It is document 2.24, so it's an addendum that can be clipped onto any of the sales agreements. From there, the policy then, the contingency, the addendum asks you to specify what kind of policy you are aiming for. Is it a sales agreement? Is a sales agreement contingent upon getting a binder that has an annual premium of 1% or some other percent or just a flat number of dollars, as well as a specific deductible, that top number for deductible, a certain amount of money or a blank amount of money. This is the bar that you must have a policy that's below. So if you're able to find an insurance company that says like, wow, we got you a great policy and it costs substantially less than you expected, that's still compliant. That's great. You got that insurance. But if all the insurance companies are offering policies that are above the premium that you were aiming for here or above the deductible you're aiming for here, then that will not be considered a fulfillment of this contingency, and the termination right is still active for the buyer at that point. They can theoretically terminate during this window and say, I couldn't find insurance that met the numbers I was looking for. This is largely based on the way Washington does its insurance contingency. It's an insurance addendum. It essentially puts a number in and says, you got to find this policy at the following numbers. If all of the insurance is too expensive, or more expensive than you were predicting, that is treated as not having fulfilled the policy, the contingency. It's just not, that's not sufficient or viable. We do say if the transaction is financed by a lender, then you're supposed to affirm that you've talked to the lender and made sure that the policy numbers that you're putting into contingency are what the lender is expecting. Generally speaking, if you've got a loan, the lender's probably got a number in mind for what they would like it to see. Usually it's the replacement value of the property is what they're aiming for on the policy and things like that. So you want to make sure that the lender is okay with whatever insurance you're going for as well, so it doesn't create an obstacle later on in the transaction. If it is not, this is the bolded language on lines 20 through 22, if your transaction doesn't have a lender, it's still a really good idea to talk to an insurance professional to figure out exactly what the coverage does. And we strongly encourage the client do that, because you don't want someone that gets insurance and is like, this is awesome. If my house burns down, I can repair the whole thing. And then finds out afterwards that the policy does not cover full replacement. It's only like half replacement or renovation or partial damage that it solves. So you just want to make sure that this meets the buyer's needs. And that may mean talking to a professional that offers these policies so that you can absolutely guarantee that the policy covers what they're looking for. Beyond that, there is additional possibility for add-ons, other selections on the insurance policy. This may be something where they just need additional coverage of a certain amount. Flood insurance coverage is a pretty common one if you're in a flood zone. Landslide insurance may be at play. Earthquake insurance, everyone knows the big one's coming, we just don't know when. Water backup insurance, umbrella insurance if you just want the broad coverage standard, or there's a blank space where you can put in other stuff. So there are various policies that various insurance companies do. If your buyer really wants this thing and they're like, look, unless I get this specific thing, if I don't have flood insurance, I don't want the house, you can write this insurance policy contingency to basically say, until the buyer gets their flood insurance within this period of time, the buyer can back out of the transaction. They've granted themselves a right of termination to that point. Is it a separate addendum not within the sales agreement? Yes, it is a separate addendum 2.24, and it's something that you can add onto the sales agreements, but at present, it's not necessarily required. I would imagine in many transactions this will be used, but it's not strictly required, so we didn't make it a part of the sales agreement for those transactions that don't strictly require insurance. And for a lot of like all cash transactions, insurance is not required by the lender, and so parties don't necessarily go for it. So it's into the future. I could see there being a point where the industry says, look, we use this addendum so often, can we just make it a part of the stage? We don't necessarily know if it's something that is going to be used so commonly that it just needs to be mainlined into the transaction sales agreements or not. And that is the insurance contingency. It's a one-pager that basically says, I have until the following date to get my insurance policy. If I can't find that policy, I can terminate. I also have these following add-ons. If I can't get those add-ons until this following date, I can terminate. And that's what it does for us. It also mandates that the buyer start the process and try and get the insurance relatively quickly. The multiple offer notice is a new form as well. We got a request in a comment where someone said, I would love to have a multiple offer notice because I get multiple offers all the time. And whenever it does, I have to tell them the same thing every time. Why can't we just have a form for it? Good point. That's a reasonable statement. So this is a multiple offer notice. It is a notice document. The seller provides this to the buyer to give them notice that they're in a multiple offer situation. Buyer, be advised, seller has received at least another offer from an interested buyer. I haven't accepted one yet. I, the seller, am gonna see what happens. I'm gonna let you all know about it, the fact that you're in a multiple offer situation, and I'll let you make a decision from there. This does allow the buyer to amend it. Technically, they can always amend their offer until it's accepted. The buyer can amend their offer at their discretion at any time until the amendment deadline. If you want to, buyer, you can make a highest and best offer if you didn't do that previously. So, by all means, please try. Seller technically retains the right to accept any offer at their discretion at any time during the amendment deadline or afterwards. We'll go into that with more depth, but we basically just provide this as a courtesy notice more than anything else. Amendment guidelines, subsections 1 through 5. These are basically the rules of engagement that the seller's putting out. Hey, heads up, buyer. If you're going to amend your offer, you got to put it in writing. Verbal offers and amendments are not going to be considered because they are functionally not valid changes to the contract. It's a violation of your code of ethics because you aren't putting everything in writing as readily as you're supposed to. So that's a problem for the broker. It's also probably a problem on like statute of frauds if you're turning in some sort of an offer in orally through a phone or something like that. That's just not considered a valid form of doing a real estate contract. So we do say, hey, if you're going to amend your offer, do it in writing, please. All prospective buyers are receiving this notice that their offers will be accepted until a specific date, an amendment deadline. Basically, hey buyer, you have until the following date. I'm not going to accept an offer until that date. You can amend your offer as you choose. You have, 3 days, 12 hours, whatever it is that your party needs to amend your thing, but you're in a multiple offer situation. Buyer is strongly encouraged to modify the expiration date on their offer to a point in time that is at or after the amendment deadline. If you're saying, hey buyer, I'm going to wait until next Monday to accept an offer, to make my choice. Your offer expired on Friday afternoon or is going to expire on Friday afternoon. Could you amend that? Could you resubmit the offer with a different deadline? Could you set it up so that I am still able to accept it because the multiple offers have come through and I want to be able to look at them and consider them critically? The buyer doesn't have to. The buyer can say, no, I don't want to, but just be aware if you're refusing the seller's request, you are not necessarily making the best. It's not the best optics for the buyer from that point onwards because they're starting the transaction off in a somewhat like tense or tenuous relationship with the seller where they've been refusing to follow through or make things easier for the parties in this multiple offer situation. Seller does technically have the discretion to accept an offer before the amendment deadline. So while the seller does say, I'm going to consider offers until the amendment deadline, I can change my mind at any time. I, the seller, can just accept an offer out of hand whenever. The amendment deadline is not binding. It's just a courtesy statement that I'm probably going to wait until the following day. The seller also can reject all or any offers. They can accept one offer and reject all the others. They can accept one primary offer and have the others placed in backup if the other people are agreeing with the backup. They can counter one buyer's offer. You should never have multiple counteroffers flying around on the same property with multiple buyers because ultimately when you send a counteroffer, you grant the power of acceptance back to the buyer, which means if I send a counteroffer to person A and person B, and person A says, I accept, and then within literal minutes, person B says, I also accept. You have sold your house to two people simultaneously. You are double selling one property. It cannot physically be done. You are probably going to get in trouble as a seller at that point. So really, if you can, make sure there's only one live counteroffer at any given time, and we kind of state that in this. There are still going to be sellers that send out multiple counteroffers at the same time because that's what people sometimes do. I would encourage you as brokers to train your client, hey, just so you know, when you send a counteroffer out, it could be accepted at any time. If you have multiple counteroffers out there, let's imagine worst case scenario, both buyers at the very same moment click the accept button and send it over to me. You've contracted with both of them to sell the same house to both of them. And unless you have two houses hiding in that one house, you're going to have some legal problems potentially. The last point there for E, the seller is able to disclose any information about any of the offers they've received from the buyer to any other buyer. They are encouraged in this. We do say, seller, we really encourage you to redact personally identifying information of any buyers that are within those offers, but that's technically not required at Oregon law or at federal law. What it amounts to is if you send an offer to a seller, that seller can take that offer and publish it in the newspaper if they wanted to. All the information in that offer is non-confidential. The only way to ensure absolute confidentiality of your offer is to get that established ahead of time. If you, the seller, let's say you're a buyer's agent, your buyer says, I want to put an offer in for this house, but I don't want any of this information to be shared with anyone else. I'm going to put some really personal stuff in this. The only way that remains confidential is if you establish that with a contract before you send the offer. If the seller signs a contract that says, I have a buyer who's going to send in an offer pretty soon here. And when you receive that offer, you agree to make it confidential. If the seller signs that, great, you have confidentiality. A lot of clients, a lot of buyers do not think that through, and they think that when they send an offer, they can also put everything I'm telling you in this offer is confidential. That's not how it works. It's even kind of undergirded by Oregon law. ORS 696-805 has a provision that says you're supposed to protect confidential information. However, the buyer's stuff is not confidential. You need to be aware of that. There's the potential that any information you send to the seller is going to get shared with potential buyers. So buyer, be aware. The last piece there, subsection 5, the seller is not obligated to negotiate with every buyer and can, at their discretion, reopen negotiations with any individual buyer or request the listing agent just keep on seeking out other offers. It essentially is just a notice, is a courtesy notice document. If you have multiple buyers in a situation, you can send this and say, heads up guys, I'm probably going to wait until a couple days later to accept an offer. If you really want to zhuzh your offer, you can do it now. That's great. Makes your offer better. By the time we get into the point where I want to make the decision, I would love to see your best offer on the table, but I don't have to bind myself to any of this, and I can just accept an offer at any time. And that's standard for the multiple offer situation, but this notice is pre-drafted and it makes it just easier for people to have kind of the same baseline, which is, hey, buyer, be aware, here are all the terms of engagement. I can deviate from them as I choose. Form 9.3C. When we've set these up in the library, we have forms that are like 9.3, 9.4, that kind of thing, and those are named forms. When we do a number or a letter afterward, 9.3A, 9.3B, that kind of thing, that generally is an additional document. It's kind of an add-on or a sister document to that original thing. So 9.3B is a multiple offer notice. It's an attachment. It should be in your sky slopes and whatnot right next to the listing agreement. If you're looking up the listing agreement, 9.3, it'll be right there after it. And so you should be able to find it in the library that way. It's just a way of like thematically organizing those documents. It's just one of those few forms that can cross the form libraries. Even a seller receives offers OR or another with ORF. Because it's a notice from the seller to the buyer, it's essentially a standalone document. So it can still be used in either library with either set of forms. It's functionally its own separate thing. In the same way that like you can send an advisory to a client that comes from the OREF library, it's an advisory. An advisory is fine. A notice document in this regard is the same thing. You're just providing notice that they're in a multiple offer situation. There's nothing that clicks it into the sales agreement or the documents themselves. So theoretically, yeah, this is one that's usable in either context with either library as the baseline for the offer, because it's just the seller saying, heads up, I have not accepted an offer yet and the following terms are potentially at play. 9.3C is a listing agreement addendum, because sometimes you gotta amend a listing agreement. It is essentially we took the listing agreement and we trawled all the information out of it that seemed reasonably modifiable. And so it was established with the central goal of just kind of having an easy one-stop shop place to modify provisions of your listing agreement. If you wish, you are able to modify your listing agreements. You can modify the term, you can modify the listing price that you're allowed to advertise it at. You can modify the compensation provisions, you can modify early termination fees, and you can modify authorizations that the client has given you. Now, I would generally encourage you to be cautious about modifying a listing agreement's compensation. This is not designed to be something that makes it easier for you to breach Sitzer-Burnett settlement terms, but the right of modifying a compensation provision in a contract is still something that you legally have the ability to do. You just need to be careful to not get in trouble with like antitrust problems if you're using this. With that said, this is not something new. You previously could also modify listing agreements with the general addendum form 9.9. There was for agency documents, there was a general addendum where you could just change stuff. And this is just a simplified variant that goes, or it's a much more complex version, but a specialized variant that is just for the listing agreement document. And depending on what needs to be changed, you can put it in these provisions. Now, one thing that is worth noting, this does not have provisions in it for removing authorizations. So if, for example, the client says, I previously allowed you to use a lockbox, then I read an article about somebody using a lockbox improperly, and I don't want that anymore, this document doesn't have the capacity to revoke authorizations. It's just an additive amendment. So if your client does want to remove authorizations they previously gave you, General Addendum 9.9 for agency documents, you can use that and basically say the agent no longer has the following rights. The client has decided to revoke those. That's a process that you can take. But otherwise it's just there to add things or to modify existing rights. The Form 9.13 Transfer Agreement, it is a new document that is designed around Oregon administrative rules. So OAR 863.014.0063 is a provision about transferring licensees. It's the provision that basically says, what do you do when you transfer offices? That provision has two subsections to it, subsection 6 and subsection 7. And subsection 6 and 7 basically say, here's the process for working on a transaction after you've moved to a new office, if you started that transaction at your old office. Subsection 6 is relevant to licensees in general. Someone has a real estate broker's license. Subsection 7 is what's the process for a principal broker. They are functionally the exact same language. They just changed the word from real estate broker to real estate principal broker. So same information across the board. It's applicable across the board. The way this provision reads is, following a license transfer, a real estate broker can continue to engage in professional real estate activity on transactions that began while associated with the sending principal broker under a handful of limitations. Basically, you started your file at the old office, great. You can still work on it even though you don't work at the old office anymore, because you're allowed to transfer to the new office and continue working under this specific subset of rights. It applies only to transactions involving the sale, exchange, purchase, lease of real estate, where there is a fully executed contract or active written offer or counteroffer or letter of intent. So only applies to active licensed transactions. It can only be done with the client's documented approval, and it has to be done with a written agreement between the sending principal broker and the receiving principal broker, the old office and the new office. And that written agreement has to have a whole bunch of stuff on it, such as identification of who's responsible for supervision and records, who's in, identify the transactions that are moving from one office to the other, statement of the effective date, when does this whole thing start. It has to address agency relationships, it has to specify compensation handling, and it has to be signed by the principal broker, the receiving broker, and the transferring broker. And it also can only be done with the written consent of the client. There we go, I skipped that one. Can only be done with the involved client's documented consent. These are all established by rule. Form 9.13 is the written agreement that complies with these provisions. We just established one. Previously, it was just like, figure it out on your own. You can probably have a document for that. But we've established this to make it easier to use the transfer agreement, to do a transfer. The way the document starts is with a description. Under Oregon law, a real estate broker can continue to engage in professional real estate activity on transactions that began while associated with the previous brokerage. Great, but you can only do it with a written agreement. So that's why we have this thing. Tell you why it started. And then we begin a transfer process. Now, this is not strictly mandated by Oregon law, by the rule itself, but we've established a strict step-by-step process to try and prevent problems that could arise, and it'll make sense as we walk through it. The transfer process is as follows. First, you got to tell your sending principal broker that you intend to transfer to the receiving brokerage. Now, you and the receiving brokerage can talk this stuff over beforehand, that's fine, but the transfer process technically begins when you say, hey boss, I'm moving to the other office. Step 1, tell your boss you're moving to the other office. Step 2, your boss and you need to agree upon the transactions that you will transfer using this transfer agreement. You essentially have to agree on which files are moving and which ones aren't. Now, usually traditionally, this would be all the files you're working on, your boss is like, great, you have a good relationship with those people, let's move it across. But there could be a situation where, for example, you're co-brokering with someone else at your office, and the brokerage says, we'd rather keep it in-house, so that one's not going to transfer. It'll just become the sole purview of our office. That the co-broker becomes the full listing broker. This then states, to avoid violations of NAR's Code of Ethics, Article 1620 specifically, so Standard Practice 1620, related to inducing clients to cancel exclusive listing agreements, you shouldn't approach your client about transferring until after you've spoken with your brokerage and the brokerage has said these files are good to transfer. The 1620 basically you can get in trouble with the Code of Ethics, and as well as 696-301 for interfering with the agency relationships of the brokerage. If you go to the client and say, hey client, I'm going to move to another office, so here's what you're going to do. You're going to transfer to the other office because you like me, and I'm just going to go to my boss and say, hey boss, fait accompli, I already talked to the client, they're already ready to transfer. Do you want to tell them no and have a super awkward conversation where they then terminate the listing and then move to my new office? Or do you want to tell them yes, like I expected? That shouldn't be the conversation that's had. You need to talk with the office first before you even approach the client about the transfer itself. And the client can say, no, I don't want to transfer, I'm fine with the office I'm at, and that would also scupper the transfer itself. Step 3, transferring licensee, you, the sending principal broker, your old boss, and the receiving principal broker, your new boss, must mutually agree on the terms of this transfer agreement. Everybody's got to agree to the transfer agreement. If one of those principal brokers doesn't agree to the transfer agreement, the transfer doesn't happen. Step 4. After you've completed steps 1 through 3, you have talked to your boss, you've figured out what files are transferring, you've gotten absolute agreement between the sending, receiving, and yourself on the terms of the transfer. Now you may approach each individual client individually. This is a very express intent on this, is that the clients do not see confidential information of other clients. That includes the other clients' names. Your buyer should never know who else you represent as a buyer's agent. That's not necessarily something they need to know. So you approach each client individually. We have an appendix document that we'll get to after in a couple slides that's basically just the client's specific side of the document. Each one of your clients should get a copy of that appendix. Each one of those clients will have to agree to that appendix if they are going to transfer, and then you'll gather all those together and attach them on the back of this thing, and that will be the transfer agreement itself. Step 5, on or as soon as practicable after the effective date of your transfer, the transferring licensee has to both update all agency disclosures and final agency acknowledgments to reflect the new brokerage that's handling this transaction, if that is being something that's shifted. The sending and principal broker and the receiving principal broker should receive all and approve all documents that are required to make those updates to the listing, final agency acknowledgement, all that stuff. If the receiving principal broker already represents a party in the transaction, the transferring licensee must obtain a disclosed limited agency agreement. So if your new office also represents the buyer and you're a listing agent, well, you got to be a disclosed limited agent now to work on that file with your new brokerage that has access to all that stuff. You also have to complete and submit all documents required to transfer any active active subject to contingency, bumpable, pending, or withdrawn listings in the MLS system. That means you're going to have to basically do whatever the process is in the MLS. Some MLSs allow you to transfer, others do not. The ones that don't let you transfer, you may have to terminate that MLS listing and start up a new one in that MLS. I believe RMLS recently added the transfer process. I believe Central Oregon and Oregon Data Share still do the you have to terminate and then start anew. That may have changed in recent times though, but that was my understanding the last time. Also, transferring licensee, consult with any potential copyright owners and obtain consent for your new brokerage that lets you use any listing imagery before you post that listing up. If you move to a new office and your new office hasn't gotten permission to use the photographer's listings, you can get in trouble. Don't get in trouble. Make sure you have permission from the photographer before you use their pictures. Just because you have the pictures in your computer doesn't mean that your office has been granted that approval. You may need new approval. You may have to pay for new approval. If they're not willing to pay for it, or if the person's not willing to transfer it, you may have to take new listing photos just to put the listing on that has been transferred to your new office. That is the unfortunate reality of these transfers with the copyright context, so be mindful of it. It has caught brokers in the past. It can catch people off guard. Transferring transactions, Section 4. Transferring licensee shall continue to provide professional real estate services under the supervision of the receiving principal broker. Their new boss will supervise them on that transaction. There's a mandate of supervision when they work at your office, no matter what. So the receiving principal broker will be supervising. The transactions that are not included on this appendix will remain with the sending principal broker. If you didn't get approval to transfer this, it's not your file anymore. It's not your client. That is the baseline that is established at law. This is not a radical shift or imposing a new standard, but a number of brokers do have, like, this is sometimes a first impression issue where they're going to transfer to a new office and the old office goes, no, I'm not transferring any of them. They're like, but those are my clients. The answer is they are not your clients. They belong to the brokerage itself, which you are an independent contractor of. You may have been the office's public face with that client, but that file belonged to the previous office. And unless the previous office allows you to make this transfer, it's not yours anymore. And that's specified in writing at this stage. The sending principal broker acknowledges and affirms the transactions in appendix have client's approval and they are sales that meet the requirements of Oregon Administrative Rule. Transferring licensee must be permitted to continue accessing transaction files and brokerage systems and communications platforms and whatnot of the sending principal broker otherwise necessary to complete the transfer transactions. If you, for example, have the entire file in some specialized brokerage system, docu special something or other that is not transferable, The broker needs to have some lingering access point to your brokerage system so they can complete this transaction. You can cut that access after the transactions are done, but it shouldn't be something where the brokerage goes like, well, you previously had access to our system to communicate with the client. You don't have that access anymore. Good luck figuring it out. It should be something where we streamline the transfer as much as possible. And if that means the broker remains somewhat lingering in their access to the things that they need to transact with the client, that is established by this agreement. We have an effective date, that's when it starts. And then we talk about various breakdowns of authority. Supervision of the transferring licensees, how do we establish this? Supervision is going to be in accordance with Oregon law and the Code of Ethics and all that stuff, and it'll be performed by sending broker, receiving principal broker, other. Now, the receiving principal broker will always need to supervise the actions of the broker that now works at their office. It can also be something where the sending principal broker has some lingering supervision authority on the file that originated at their office. There are as many ways to break this down as you wish. It is not well defined in rule, so it is left broad in the capacity of like what you can put in this section, because essentially the rule allows any way you want to cut it. Similarly, we have something for records. Records for this transfer will either, records of all professional real estate activities that occur after the transfer date will also be kept by the sending principal broker. Your old office gets a copy of all the documents from this point onwards for their records. Transferring licensee will be required to provide those copies. There will also be copies kept by your current office, if that's the case. There may be duplicate records moving through the brokerages at this point. The record keeping requirement is somewhat obtuse in what it requires. The other option is the receiving principal broker gets a copy of all the old records that occurred before your effective date of the transfer, and then is the record keeper from that point onwards. So essentially, either office, one of the two offices, should have a comprehensive, complete file from start to finish. It's either your old office keeps getting documents so it has a comprehensive record, or the new office gets all the historic documents so it has a comprehensive record, or you can do other. Again, cut it however you wish. Lines 56 through 58, official recognition for completion of sale in the attached appendixes of sorts, as privately recorded in the MLS records, shall be credited either to the transferring licensee, to you through your old office, or to you through your new office. Which office gets the credit in addition to you? Basically, how does the MLS write the credit piece? There's a checkbox option. Agency relationship can be split as well. Is the transferring licensee and the receiving principal broker the primary and only agent, and the sending principal broker, your old office, has no interest whatsoever in the agency relationship? They cease all agency. Is it something where the sending principal brokerage now provides support as necessary and are still somehow connected to the agency with this client? Or is it something where the sending principal broker remains the primary agent and the transferring licensee is just operating under the auspices of the previous old brokerage? It can be any of those three. Now, there will generally be a process that your office will default to. I would assume your office will have one of these options, like that's the only reasonable one. But many different ways can be done. There's also an other category if you have a fourth quaternary version of this agency relationship. And then compensation. Who gets the payment in the end? Who gets paid? Is it something that goes straight to the receiving brokerage, your new office gets the money and then parcels it out to you according to the independent contractor agreement? Is it something that's sent to the old office and then the old office transfers that money to the principal broker, the broker that worked with them according to 696-290? The old office can still make payments to their previously licensed associated brokers if they do it directly under Oregon 696-290 compensation sharing rules. So there is still the capacity where basically the client pays the old office and the old office parcels out the agent's individual share from the take. But then it's essentially a question of like, which office is receiving payment for this? The broker themselves will be paid through the independent contractor agreement one way or the other. And then there's an other category because offices do interesting things with compensation. There is an indemnity provision, which is designed to cover both parties. It is a mutual indemnity. It basically says your old office is responsible for all the stuff that happened until the transfer. Your new office is responsible for all the stuff that happens after the transfer. If your old office messed up before the transfer, the new office doesn't get in trouble for the things that got messed up before they even knew the transaction happened. The old office will indemnify. They will pay for the attorney fees for the fixing the problem for the new office, for everything that happens from the transfer point onwards. Alternately, if the new office is in charge of this thing and they screw up, the old office shouldn't get in trouble for that. If a lawsuit comes out and you have to get a lawyer to write a letter to explain why you're not in trouble because you transferred this file and you haven't touched it since then, the new office pays for that lawyer for the old office. It's the transfer point shifts the moment of liability, and if you're basically the moment you give up your obligations on this transaction, You should not be responsible for things before or after that moment where you took it on if you didn't touch the file from that point onwards or up until that point. And lastly, section 11, attorney fees. If there is a dispute over the transfer agreement and you win your dispute, you get your attorney fees. There should be no point where if you have a reasonable or a good argument for arguing that this transfer agreement was used improperly or violated, there shouldn't be an attorney problem where you go like, gosh, I would love to fight this transfer agreement because I think I'm in the right and I think my previous brokerage screwed up in the way that they're looking at this and I don't think they're correct, but I just can't pay for an attorney. If you are in the right, if you have your attorney, like if you believe that you have the strength of argument to win this thing, your attorney fees will be covered after the fact by winning the argument over the transfer agreement. That's the general. This is kind of a standard in Oregon law and in Oregon contracting, but we've mainlined it into the contract to just say that, which is if you are strongly opinionated that you are in the right in how you interpret the transfer agreement and the previous brokerage or the new brokerage disagrees, there should be no dispute or a problem where you're like paying money out just to dispute the validity of the contract, because you should get that back afterwards if you win. Now, what that does mean is disputing the transfer agreement has a double cost if you lose. The appendix is an additional document that is at the end of this. It has a specific blank space for the client's name as well. The use of the appendix is designed separately for each individual client. Each individual client should receive one of these for each transfer that you're making with that client. The appendix is going to be designated with the client's name. Each one should be unique to that client. Make it clear that this is, they're not in special, they're supposed to be like glommed together and sent out to the clients. And it basically says, I, the client, have been informed that a transfer is happening from one office to the next. I get it that there's going to be some change of pace, and the legal relationship between myself as the principal and the transferring agent will either remain at the original brokerage or transfer to the new one of those two, and I'm fine with it. And then if the client signs it and dates it, that's the client's consent to the process. If you have the sending office, the receiving office, the client's consent, and the broker signing it, congratulations. Transfer is valid under Oregon rule. That transfer works. This is the whole of the transfer process. It's not designed to be super complicated originally. I don't think it was, but it has slowly become complicated. And our hope is that this form will make things easier for folks to make these transfers happen, because they've been doing it kind of cowboy contracting across the state. There are many, many ways this has been done. And our hope is that centralizing a document will make it easier for everyone to sort of start establishing a central practice for how transfer happens. From there, we're outside the major changes. Everything from here on out, minor stuff. We'll begin with Forms 1.1, 1.1a, 1.2, 1.3, 1.4, 1.5, these sales agreements. These are all the sale agreement documents in general. There is one substantive change to it, which is the FinCEN stuff. If you've been following the FinCEN disaster of law that has been happening, it's a mess. FinCEN is the Financial Crimes Enforcement Network. It's a branch of the Treasury Department. Their whole thing was established with the Anti-Money Laundering Act back in the 1990s, and it was designed to stop money laundering with businesses and with property, and to stop money laundering in general. FinCEN writ large was kind of inactive until relatively recently. It was about 5 years ago that FinCEN really picked up, and they started doing a lot. One of the things they did was that interested business in owner thing that then was aborted, and they flipped that and they said that didn't work either, we're going to get rid of it. Another thing was their real estate reports. FinCEN put a thing in last year that said, hey, if you are selling real estate to certain people, if there are certain sellers or certain purchasers, certain transferee entities or transferee trusts who are generally foreign entities, so like a foreign person or a foreign company that are making a transaction and it's all cash, it's not something that's like followed by a lender, that's a place where financial fraud and money laundering is rife. Like the mob is filing money through properties regularly is sort of the expectation. And as a result, there was this enormous, like a very robust report that you had to file. Escrow took that up. Basically, if you're going to do the report, Escrow got it filled out, and they would do that process. Then in early 2026, there was a case in Texas called Flowers Title Company versus Besant, and Judge in Texas basically said that rule is not okay. It breaks outside the rule, the authority you've been granted as the Treasury Department. You're not supposed to do that. So they invalidated the rule nationwide, which means FinCEN's real estate reporting rule doesn't exist anymore technically. And then a couple months later, the Treasury Department filed an appeal, and it's working its way through the pipes, and we'll see what happens next. But literally at any moment, a court could say, based upon this appeal and the nation danger that we see as a nation, national security that comes with money laundering, that previous removal of the rule, that invalidation of the FinCEN real estate reporting rule, it's back on the table. We're putting it back on the menu. It's a thing that happens now. And that could happen at any time with a judicial order. It could happen today. It could happen in a couple minutes. It could never happen. We don't know what's going to happen next, because it's kind of in the world of the courts now, and who knows what happens and whether an injunction is offered or not. So we modified the FinCEN real estate reporting rule to basically say, if you have to file a real estate report, and escrow tells you you have to file a real estate report, then we'll follow the FinCEN rules. It's not a requirement anymore. It just says if you are required to, then we'll do the FinCEN stuff. And so it's been made very wishy-washy because the law is rather wishy-washy about FinCEN right now. And that's just kind of what we're stuck with until we get an affirmative final answer on this. If, for example, the judge in the Besant case in Flowers Title goes, yep, Texas was absolutely right. This rule is an aberration of law. Get rid of it. We'll probably see this whole FinCEN real estate report thing just disappear from the form. It'll be taken off because it doesn't need to be there. If the judge disagrees with the guy in Texas, then it might just be back and it's in full force and effect. So just keep your eye on the emails from Oregon Realtors Legal, because there's a chance that things will change in real time, and it can be rather expensive when you have to file those real estate reports. They are an additional cost through escrow typically. So that's what we're left with there. There was another change to 1.1. I didn't put it on a slide because it's kind of abstract, but on the financial terms provision, when you talk about how much of a concession you're offering or how much is being paid to a broker and things like that, we added as much blank space as we could to the money number so that you can put a larger, like for the thing that's like, how much are you doing in other concession fees? People were putting in rather large numbers on very expensive properties, and they're like, it just keeps getting so small on zip forms. And so we've lengthened that line out as much as possible. It's just the lines got longer on a couple documents. To the invitation to escalate form. This is the Oregon Realtors version of an escalation clause. It's designed as an escalation clause, but rather than one that you do in real time after you've accepted the offer, it fiddles the offer before it's accepted. And so it creates an absolute term agreement on the escalation rather than creating something that's floating or springing in the contract. If you haven't looked at it, I encourage you to. It's curious, it's interesting, it does things, but there's one change to the form. There's a part in it where we talk about the purchase price escalation. It's based off a net purchase price. Now, net purchase price is defined as the stated purchase price, adjusted down for credits to the buyer and adjusted up for credits to the seller. So if the buyer is paying stuff that the seller was otherwise going to have to pay for, the number goes up. If the seller is paying for stuff the buyer otherwise had to pay for, the number goes down. Think about it as essentially like the profit the seller is walking away from the transaction with. When you tell a seller, oh, you're selling a house for $100,000, that's awesome. They're not walking away with $100,000. Typically, that's a different number is what they're walking away with. That's essentially what we're looking at in this net purchase price. It's a similar thing there. You're asking how much is the actual value of what the seller is getting from this transaction. The reason for that is you would oftentimes have a transaction that have the exact same purchase price and then different concessions that fiddle the number a bit. And if you escalated one offer that was like a lower number up to another one, but by concessions, they were already like comparable originally, it got messy. And so our goal was to make net purchase price the fiddling number so that you then had less of a situation where the seller felt like they were being taken advantage of. We defined some of the terms for net purchase price with an addition there. It previously said, for example, when we say monetary credits to the buyer, like closing cost payments, paying off the buyer's closing costs would be something that would adjust the number. Also, seller payments to the buyer brokerage fees. If the seller is paying the buyer's broker, that is something that is also adjusted off the net purchase price. We thought that was originally how people were going to understand this, but there have been confusions in the market. We learned that from a couple legal hotline messages, and so our goal is to try and make that as straightforward as possible. Connie asked, if the buyer paid a FinCEN fee in March, are they entitled to a refund? I would encourage you to have that client talk to the title company Generally speaking, I don't believe they would get a refund, but your title company, your mileage may vary by title company. The problem the title companies are running into is if they have done FinCEN report, then they did extra work and labor, and that's what they're generally charging you for. So I doubt that you're going to see refunds for that. But title companies also don't want to be seen as these money grubbers. So like, there's a chance. I just don't know what your individual title company will do. But back to the escalation. Basically, we redefined or we added a definition to the concept of net purchase price so that it makes it a little more obvious that when you have a seller paying the buyer's agent, that modifies the purchase price down. If the seller is paying for the buyer's agent, you would subtract the amount of payment to the buyer's agent away from the purchase price that you have on the form to get your net purchase price minus that payment. It should be a lower number typically. To the counteroffers. Minor changes on the counteroffers. In the first edition of 2026, we updated the forms library and added form 2020 1.1a, which is the seller side sales agreement. Basically, it's a sales agreement, all the same as otherwise, but it comes from the seller rather than from the buyer. This is used in those situations where the seller is like, you're an unrepresented buyer and my agent can't represent you. And I really don't want to get in this messy thing where you're like, well, my agent told me that this was a good contract to use and then I got a bad transaction. Instead, the seller can just make the offer to the buyer. They can start the transaction. They can be the one that jumps off the fence. Because the seller can make an offer, the buyer might be counteroffering a seller's original offer rather than a seller's counteroffer. And so a checkbox has been added because sellers can make offers as well. And so now there's just more checkbox clarity. There's a problem that popped up and someone in their comments said, hey, I had this situation where I made a seller's offer and somebody counteroffered it, but they didn't know how to check the box. And I was like, that's a good point. We didn't have a checkbox for that. On the lead hazard thing, you may have noticed in recent times that your lead hazard documents had this weird addition to it, which is if the seller agent pays for the buyer agent's fee, if the seller pays the buyer agent's fees, then the buyer agent has this obligation to tell the seller agent about their obligations at law. That was established through the EPA's modifications. The EPA changed their model form to say it would. I don't know why it happened when it did, but they did. They changed their form to have that language. The model language had this inclusion that said, well, if the seller is paying the buyer's agent, the buyer agent owes this seller the obligation of explaining all their lead requirements. Originally, it was likely designed to cover unrepresented buyer situations where you have like FSBO situations, rather than not unrepresented buyer, FSBO, where you would come up to this for sale by owner seller and say, hey, for sale by owner seller, selling a house that was built in the 60s. My buyer wants to buy your house. And the seller goes, great. And they have no idea that anything about lead is at play. As the buyer's agent who knew about lead, you were supposed to say, hey, seller, your house was built before 1978. There's a chance you have lead in the paint chips. There's a chance there's lead dust in the soil. There's all kinds of lead problems that potentially are at play, and that's against federal law. So you have to give my buyer a period of time to inspect. You have to give my buyer a chance to get disclosures. You have to tell me all that this stuff and give me a pamphlet and all that stuff. You as the buyer's agent is the only knowledgeable party in the transaction. We're supposed to be telling the seller that. That's what the EPA viewed this as. They're like, oh, awesome. We'll have the buyer agent tell them these things. And then Sitzer-Burnett happened. And now there's a whole bunch of situations where a seller is paying a buyer, even though the seller still has their own agent. And the EPA's language is not designed with that in mind. So we had to modify our forms. And we modified it so that in the agent's acknowledgement section, it just mainlines that in. Hey, just so you know, if the buyer's agent is getting paid by the seller, lovely. This form, by signing it, seller, you already acknowledge that the seller's, you have been told all your various obligations under law. You have to provide a lead hazard informational pamphlet. You have to disclose the presence of lead. You have to provide the reports that are available to you. You have to give my buyer a 10-day period to look into lead stuff. All that is known to you now. Checkbox, buyer's agent has done their job. By using this form, it automatically completes that compliance piece with the EPA. So it's just in there. You don't need an extra document. It's all just in the form. On the well addendum, there was a minor modification as well. Now, previously it said within 2 business days after mutual acceptance, the seller is going to give their well logs and stuff to the buyer. And within 2 business days after mutual acceptance, the seller was going to order well tests. And within 2 business days after mutual acceptance, the buyer was going to order their extra stuff like flow tests and whatnot. There was just a 2 business day timeline that was like, everybody order your tests. There was a request we got from a person that basically in the comments that basically said, I would sometimes like more time. Could you make that flexible? So we made it flexible. If you need more than 2 days, great. You can add more than 2 days. If the seller needs a whole bunch of time to like go rifling through their manila folders and files cabinets and unlock that gun locker they've never opened for years and things like that to find the documents, then great, they can do that. They can give themselves 6 days, 10 days, however much is required. I would generally encourage you to keep that number pretty tight. I don't believe you necessarily want the well ordering process or the receipt of the well logs to lag substantial periods of time into the transaction. It's usually something you want to know upfront or as soon as possible. So don't necessarily say like 30 days because that'll potentially cause problems, but you have the ability to add flexibility. No other changes to it, just flexibility on when you order stuff. The septic stuff had the same change. You have a flexible potential amount of time to provide on-site maintenance logs and all that stuff, and you have a set amount of flexible amount of time to order the various septic pumpings and inspections and whatnot. So you just have flexibility. Everybody likes flexibility in their contracts. On the seller's contingent obligation to sell. Now note, this is not the contingent right to purchase. That's a buyer's form. Form 2.10 is the buyer's contingent right to purchase. Form 2.12 is the seller's contingent obligation to sell. This is the one where rather than the buyer saying, I got to sell my house before, because if I don't sell my house, I'm not going to have money to buy yours. This is the seller saying, I'm going to sell my house to you, but only if I have another place to live afterwards. I need to have found my replacement property before I am willing to sell my house because I don't want to live in a hotel for several months before I can finally find a house. It's used for the sellers that are like, I sort of want to sell, but I really want to make sure I know what I'm doing next. The ones who are not cavalier about their sales, the sellers might use this. We replaced some pieces of it just because there are issues that arise at times with the replacement property. The first piece is on section 3, where you actually lay out what your contingent obligation to sell is. Now, typically it would say the sales agreement is contingent upon, and then you could make a choice. The seller accepting an offer, the seller releasing their due diligence contingency, a waiver of an appraisal contingency, the seller's successful closing on the property, if you're really willing to go that far. But basically, there was something that had to happen. And until that happened, the seller had a right to back out of the contract. And if for some sellers, it's like, look, until I literally have bought the next house, I don't want to sell my house first because I need a place to live. And you could check that it's only upon successful closing that this contingency is gone. We added a piece in there because it's material. We think it's material information based on comments from users. The seller shall seek out their replacement property while represented by a buyer's agent or while not represented by a buyer's agent. The idea of having a buyer's agent help you find the next property or replacement property is potentially material in the way that it impacts the search. If I have a seller that comes up to me and says, I'm willing to sell you my house, but only if I find the best replacement property that meets all my needs, and you're like, great, how are you going to find it? And they're like, oh, I'm just going to Google. Like, that might work, and that's great. There are a lot of people that are using ChatGPT to try and sell their house and buy houses and things like that, so they might find stuff. But there is something materially protective around the concept of knowing that a professional is guiding the process. And we believe that that was something that buyers should know. If the buyer is going to agree to this potentially broad spanning contingency, they should know how likely is it that this actually succeeds. Does the seller at least have access to like an MLS? Or are they just using Zillow and apartments.com to try and figure out their next move? Because that might change things dramatically. Question in the chat, what if you ordered, when you got the listing on the well test, does not specify you can use a test before offer accepted? That is, I will address that question a little later on. Well, that's not something that's in these trainings, but if afterwards we have the time, I'll get back to that. So Melissa, keep a hold of that question because there's a really complicated answer that is more legal than I want it to be for something that should be a simple one. But hold on to that because I will get back to it if we have the time. The other piece on this is down in the actual contingency itself. The seller has until a certain period of time on their contingency during which they can just terminate contract at any time. At any point before that contingency deadline, the seller can notify the buyer in writing that they've fulfilled whatever you checked on section 3. They're like, I had to purchase my replacement property. At any time, the seller can say, hey buyer, I bought the replacement property. We're good. And that's great. But until the seller provides that notice, the buyer has a right to back out of the contract. Essentially, it mainlines the same process that you have to some extent in the contingent right to purchase on the buyer side, where at any time the seller can say, got a better offer, fish or cut bait. The buyer can back out of a contingent obligation to sell property until that contingent obligation has happened, because oftentimes the buyer is looking in other places when they're under this contingency, because it's not certain. The lack of certainty means that we need to give the buyer some sort of a way to be able to say, all right, I moved on. I know you've been looking for your replacement property, but I have moved on because I got no notice in any way that things were moving forward. I found something else to move with. Previously, that wasn't there. Probably the buyer could still have backed out of the contract and said, look, I'm done with this. I'm terminating. I don't need to be in this contract anymore because you still haven't fulfilled your contingency. And they probably wouldn't have lost their earnest money. In this case, we've just mainlined that understanding of how the law previously probably would have worked into the way the contract objectively and expressly works, which is, seller, if you haven't fulfilled your contingency yet, the buyer can back out and there is no harm, no foul, because both of you were only halfway into this transaction at this stage. Into the release of contingencies, a very minor change. It now, in the release of contingencies document, the concept of a release is that you're basically saying, I don't need to take this termination right that was associated with the contingency. I don't want it anymore. I don't need to use it. There's a modification to it that now has an other section that was other contingencies, and it's now other contingencies and provisions, because sometimes you're going to be terminating for other reasons that are more than just contingencies. So a buyer is satisfied with and affirmatively releases the following contingencies or provisions of the sales agreement. So if you do want releases for your various things, like various non-contingency things that have a termination right associated with it, I have a later slide in the presentation that actually mentions those, you can use this to fulfill that release. It is not strictly required. I would like to note that release is more a document that brokers oftentimes use as a way of creating a paper trail. It's not something that creates contractual, it's not required as a contractual level. If I do not use my termination right in an inspection, I don't then need to release the termination right that I didn't use after the window has closed. After, let's say the inspection, I'm allowed to inspect for 10 days. The 11th day has happened. I don't technically need to release the inspection right because the termination right has essentially withered on the vine and it's no longer ripe. But a lot of brokerages use the release documents to essentially say, in addition to the right having withered, I'm going to release it to make it really affirmative that I'm not terminating because this inspection didn't, I didn't terminate based on my inspections. It's an additional document that people have access to in the library. The association addendum 4.4. We modified a couple pieces of it where it talks about dues and costs for parking spaces, slip spaces, that kind of thing, storage. Some HOAs charge quarterly. We previously had just monthly and annually, and some charge quarterly. So there's an option for quarterly now. If you have experienced HOAs that do something other, let us know. Is there biannual payments from HOAs and things like that? Have people run into that? Because we can add another checkbox as time is as needed for these sort of things to just make it applicable. I don't know how many would like assessment. What do you mean by that, Melissa? Oh, something like when someone gets assessed fees based on some centralized change of the brokerage or the HOA, where they're like, a place to put in a special assessment. Okay, I'll make a note of that. That is something we can. It's probably something that'll show up in 2027-1's forms, but I have made a note of it, and it will be something that we work on the next set of forms. So we'll work on that. But this is the change that we have to the HOA document, just the option for quarterly. On the receipt and delivery of association document, there was previously a thing that said once the document was delivered, you were supposed to acknowledge the receipt of each document with an initial. Our task force looked at this and was like, that is just onerous, and nobody really cares that much about the initial on this document page. So all reference to initialing has been removed. All you need to do now as a seller is just deliver the documents as you said you were going to deliver, and or specify if the document doesn't exist. But there's no longer a requirement where the buyer has to respond by saying, I received all the things you said you delivered. It was seen as overly procedural and not necessarily useful. On the commercial assignment of lease, we added a piece in there so that you could specify how much the tenant pays in rent and what day of the month it is that they are paying that rent. Sometimes that'll be a different number. Some tenants will have a longer period of time, some will have a shorter period of time, but just more information for the potential purchaser to figure out what they're dealing with their tenants. On the exclusive listing agreement, there was a modification of the holdover provision. Holdover provision is a piece that says after you are terminated or after the contract expires, if the seller sells the property to somebody that you got in contact with them, then that would be a delightful thing. You could get compensated for that because you did the work that initiated that process. Essentially, it's saying I've earned the right of compensation, even though there was a termination. The seller was obviously kind of benefiting from the fruit of my labor. We have a provision that's been added to it that is the agent needs to provide the seller with a list of all the people they got the seller in contact with, within 5 days after the expiration or termination, if you want to take advantage of that holdover provision. If you are going to argue, seller, you owe me a commission because I got you in contact with the person that bought the house, put that into being ahead of time. Essentially, it should be something that you have that is in place shortly after the expiration of the termination. You need to give them that list. Beyond that, there was also a change to the listing agreement that adds in what's called, in law, it's called the clean hands doctrine. It's generally an application of, like criminal and civil law generally will have this doctrine, which is you can't enforce a contract that you are in breach of too. If you are breaching your contract, you can't also claim the contract needs to be enforced. Both parties, if both parties are in breach, then it's kind of seen as a no harm, no foul, unless one is like much more in breach than the other. But these clean hand doctrines generally say if you're in breach of your own contract, you can't enforce that contract that you are breaching. So we added in on the early termination fees. It's only really available when the seller's agent is not in breach of this agreement or their agency duties, because we had situations where a broker would go radio silent, and the client would be like, agent, where are you? Agent, nobody? Okay, fine. I terminate this agency relationship. And then the agent would show up and go, well, because you terminated early, you owe me compensation. And it's like, well, that's not what this is designed for. That is not the way this plays. You have to be actively acting as their agent properly to be entitled to an early termination fee. It's not a penalty. It's something that's designed to cover the agent's expenses in large part. That's what it's largely designed as, it's a liquid damages sum representing the amount the agent expends in their potential representation of this client. It's not designed to just make it hurt. In the buyer representation agreement, we put the same thing in. If you are going to be utilizing an early termination fee, you have to be fully in compliance with your own agency terms, your agency duties, and your agency contracts. You cannot take advantage of early termination fees if you are the one doing the things wrong, if you're the reason for that termination. 9.12a is an addendum. It's a sister document that goes with that team's disclosure, the real estate team disclosure. It's the one that has just extra space if you have a really big team and need a whole lot more people. We added in a chunk on that for transaction coordinators. This is technically not something that OREA has in their established form, so it's an extra, it's an add-on. Transaction coordinators, the provision basically says the following individuals are transaction coordinators employed or contracting for a different company, external of our brokerage. If they are transaction coordinators working with your brokerage, they're just supposed to be on the team's disclosure. If they're working with your team, they are just a member of the team to some extent because they're working with the brokerage. What we have, though, is a bunch of transaction coordination companies that are not part of the brokerage, but instead are like hired contracting services. And if that's the case, specify who the transaction coordinators are, whether they're licensed or not. And we do note that the transaction coordinated company is neither an affiliate nor a subsidiary of the brokerage or the team. It's just some tertiary company that is providing the transaction coordinators, but you still should be disclosing the existence of these transaction coordinators. On the EPA lead pamphlet, it changed. The EPA updates that lead pamphlet periodically. Generally, this is to modify the numbers of what a safe amount of lead is. As testing gets better and better, the number of like micro, nano particles and atoms and things like that they are willing to say is a dangerous amount of lead shifts. The same is true. So of a new version of the EPA lead pamphlet, It just has different numbers for the dust lead action levels and dust lead reportable levels, and it changes the definition of abatement slightly to modify that a bit. Older versions of your lead pamphlet are still technically valid. They're not something that needs to be discarded. There is a supplement that is available on the EPA's website. I would encourage you to grab it. It's just a notice document you send to the client as well that says, hey, I sent you the EPA lead pamphlet. Stuff has changed from the EPA since then. See this document. And so I believe it's like a one-pager. So if you have transactions that were using the old version of the EPA lead pamphlet prior to July 1st, 2026, go to the EPA's website, grab the supplement. You can use that. Other stuff. There were some others, and this is where I'll talk about the like null sets and the reverse options where a comment was brought and it was not fulfilled or it was not acted upon. To begin with, other removal, there was a form that got removed from the library. Form 9.3a, it was the settlement amendment to listing agreement. It was designed for right after Sitzer-Burnett, when the MLSs changed their rules dramatically, your listing agreements needed to comply with the MLS changes in real time. So we designed a document that basically took the existing MLS and like spackled pieces onto it so it looked like a compliant document that followed the settlement. There should be very few or none listing agreements left over from prior to the Sitzer-Burnett settlements that are that need this amendment document. It was 2 years ago. If you have a listing agreement that has not been modified yet, and you're using this listing agreement from way before the settlement, adding this addendum to make it compliant with the settlement is sort of irrelevant at this point, because Oregon law requires that you talk to the client once every 2 years. Basically, the listings should be all compliant with the settlement at this point, and this addendum document is an extra, it's an add-on, it's not required anymore, so it was removed. There are some changes that were rejected. So, for example, there was a request that we define the term delivery as either upon receipt of the document or upon relinquishment to a mail carrier / mailbox storage place. Both of those have, depending on definitions, can be viable interpretations of the concept of delivery. When I receive a document, it has been delivered to me. When I put the document in your mailbox, before you open the mailbox and take it out, I have delivered the document. The request was basically, I need like really granular definitions of the word delivery. And our task force said this is probably going to create more problems than it would solve if we put a super granular definition on the term delivery, because then we'll have people arguing about like when their mailbox sent the email versus when it was received in the other folder. And we'd rather just leave it as the abstracted version that it is currently, which is essentially whatever common law defines it as, and for the situation, it's going to be different. If it's something where we're asking, when did you send the document? We're going to look at when you sent it yourself, out of your hands, out of your control. If we're asking, when did the other person get the document? We're going to be asking, when was it received or relinquished into their control or their possession? So the task force basically said, let's not invite the Pandora's box of like legalese definition argumentation over delivery. There was a request that we modify the repair addendum to have a response deadline. So it would say, here's my repair addendum. You got to respond by the following day. And the task force rejected that as well on the grounds that the due diligence timeline is already a closing window. And having a due diligence timeline and a closing window on the repair addendum would be a deviation from the standard that exists in most practice right now. So if I said, for example, you have 10 days to do your due diligence and your inspections, and then I send you a repair addendum, say, please respond to this repair addendum by tomorrow, the party that receives that repair addendum may still be thinking, I can sit on this until the 10th day and make my decision, because that's what you've been able to do up till this point. And the task force's view on this was essentially, it did not add anything materially useful to have a response deadline on the repair addendum, because ultimately they are open-ended addendums, and I can send multiple addendums or withdraw them or change them as necessary, because it's part of what amounts to an interactive negotiation between the parties rather than a call-response style document like an offer. There was also a request that the repair addendum have a counter-offer option on it, and that was rejected as well, in large part because the repair addendum currently says, I accept the repair addendum, I reject the repair addendum, and that makes a very obvious binary. Either I have accepted all the terms, or I have rejected the terms, and we are not doing those repairs. Everything makes sense. If I put counter-offer in, and someone says counter-offer, and then a different set of things are delivered on that repair addendum, it's not clear what is being said. For instance, if I said repair addendum offer to you, you the seller have to repair the roof and the foundation, and your seller responds counteroffer, I will paint the house. It's not clear if they said, I'm going to paint the house, do the roof and the foundation, or I'm only going to paint the house. And that lack of clarity is something that could invite a substantial amount of conflict if parties autopilot into it. And so the task force basically said, like, this is not the way it needs to be done. A binary process for repairs is going to be the most straightforward process, because you can just say no. Here is instead my offer of repairs to you. Do you say yes or do you say no? And once you get a no, you know that that repair is off the table and it's completely changed. There was a question in the chat for clarification on the notice of completion of repairs. If the buyer accepts the repair after they are completed, the buyer does not need to sign the notice of completion. The buyer only signs if they dispute the repair. Yes, it is a notice if the buyer is just receiving it and they're happy with it. If they wish to dispute, then they respond with their documentation and stuff. And it becomes more of like a interactive process at that stage. But if the seller just sends the notice and the buyer doesn't provide any response, it's just a notice, and the buyer doesn't have to say, I accept your notice, because then we would have a question of like, well, what about the seller accepting the buyer's acceptance of the notice? And we could move down that way ad nauseum. So to some extent, law in general kind of avoids the concept of accepting a notice or proving that a notice has been accepted to make it valid, because that acceptance of notice provides an entirely separate kind of legal process in there that is seen as repetitive and unnecessary. There was a request that we got as well that was there should be some sort of checkbox on the release document for things like home park rules and septic tests and whatnot, where I'm like, whatever, I don't need those septic tests anymore. The task force said, yeah, that's a pretty solid point. Those are important things, but the release document doesn't, it's pretty informative about how it releases contingencies, and adding all that information in seems like it would start deviating more and more from the concept of release. So we just broadened out the other category rather than making distinct checkboxes for each other thing that you could release in a contract. It is now distinct releases of contingencies and then other stuff for all the other provisions that you wish to release. There was a request that the seller-occupied transactions documents, the post-closing seller occupancy, should be modified so that the seller doesn't have to pay for appliances that they damaged post-closing. So like the seller is living in the house after they close and they break the washing machine or the dishwasher. The current forms say, look, if you break it and it's not in the condition it was as of the intended day of closing, you gotta fix it back to the point it was at. So the buyer should be getting roughly the house that they had at closing, even though the seller lives in there afterwards. And people are saying like, this is so messy, but it's like, it's the buyer's dishwasher. Who cares? Why? That's the buyer's problem. Sure, my seller's living in the house right now, but that's the buyer's problem. That's how it works in landlord-tenant land. If the washing machine breaks, or if some integral part of the property breaks, the landlord's supposed to fix that. It's not the tenant's fault that it broke. And the task force basically said, we're going to try and keep the walls between the Landlord-Tenant Act and these occupancy things as firm and objectively different as possible. We don't want the non-occupant party of a transaction to have to act as a landlord under Landlord-Tenant Act expectations, because that creates a whole bunch of, there's a burl of other legal complications that come with being the landlord. And so let's just leave it what it is, a relatively reasonable standard, which is if you're living in someone else's house and you break their stuff, fix it. That's the standard that should be there. When you're living in someone else's house and it belongs to them and you break stuff, you should be the one fixing the stuff that you break. There was additionally a request that there be a mutual termination document, somewhat like the OREF mutual termination agreement. Basically, a person's comment was very robust in explaining why they said the mutual termination would be super useful and helpful and it's important. And there are some situations where you have a buyer and a seller that want to terminate the contract and they're totally fine with it. They both agree that this thing needs to die and they're willing to let the contract fall apart. And in those cases, it was the person was like, it's just repetitive and confusing to have a notice of termination and then a response to termination, and that doesn't make sense. And our task force discussed this a lot. There was a fair amount there was a lot of discussion about this exact concept, and the end result was the task force said the termination process that we have in the Oregon Realtors Forms library is designed very intentionally as a notice, one-way document. I send you the notice, the contract is terminated. We don't have to ask questions about what if you don't agree with my termination. I don't have to say this is an agreement, please sign it, because it's not valid until you sign. I just send the notice. And upon receipt of the notice, my notice has happened and termination has occurred. We have terminated the contract. Now we have to have a response document because Oregon law blocks escrow from sending the money back out. 696-581 basically says escrow can't do stuff with the earnest money until they have agreement from the parties, mutual agreement on separate instructions, or a court order. And so we have to have an extra document that basically says, I, the seller, agree with the terms of the mutual, like the earnest money instructions, or I, the seller, don't agree with the terms of the earnest money instructions. We're still arguing about this. Based on Oregon law, the response document is required. But otherwise, we don't have a question of agreement and mutuality that we have to kind of establish or mainline into the process. The task force's primary concern was many brokers in the state are very comfortable with using the mutual termination agreement document, which means they will default to using it as much as possible because the unknown is scary at times. And so we would probably see this exception document becoming the norm. It would become the standard termination thing, and we would get right back to where we started originally, which was one of the central proponents of why we started shifting the termination documents in the Oregon Realtors Forms, which was people will start sending these mutual termination documents not because it's the best document, but because it's the one they're comfortable or familiar with. And as a result, we'll have questions of what happens when somebody disagrees with the termination, what happens when the parties agree to terminate, but they disagree on the earnest money instructions, what do we do in the situations where, for example, a termination document gets sent unilaterally and doesn't get signed until several days later, when was the actual termination proper? None of that will be at play. And so while it was seen as something they're like, yes, there is a use case for it, the use case would likely absorb the norm, and that's something that the task force said we like the standard as it is. We think it is a superior process to terminate the contract because it avoids so many legal quandaries, but simultaneously it's a shift from the way that OREF does their forms, and as a result, people will likely deviate to whatever they were comfortable with or trained on, and it will take an act of God at that point to get people back to understanding or using the Oregon Realtors notice of termination, response to termination process, if people can just jump away from it. And that is the changes and the non-changes of 2026-1, or 2, 2026-2. These go live on July 1st. They're already sent out through the platforms. Platforms should have all this stuff live. It should be something that is completely ready to go. Are there any questions? There was a question earlier from Melissa about well stuff. What if you ordered and got the listing, got your well tests before you listed the property, or while you were listing it, not before the offer was accepted? So the question that you had there, Melissa, where it comes complicated, is under Oregon law, there are requirements for well testing, and under law, it reads, well testing must be done every time you accept an offer to purchase the property. Now, with that said, administrative rule under OAR 333 that's run by OHA, it says well tests are valid for 1 year. And to be honest, it's not really clear, and no one has really defined it anywhere, what that means in conjunction. There are two interpretations you can take. It's either your well test is valid for a year, so if your transaction goes for more than a year, you got to do another well test. Or it means if you did a well test for the next year, just keep grabbing that thing, it's good to go. That second interpretation likely violates the exact strict reading of the administrative or the law relating to well tests. It says you need to test this well every time you accept an offer to purchase property. But that's not how the industry runs it. So more likely than not, my assumption, and I can't say this with legal certainty, but OHA seems to be okay with the idea that a well test is valid for a year of time. So if you got it during the listing process, you can send that to the seller and it will be compliant with administrative rule. But that's not something that is strictly upheld by the literal language of the law, and it gets messy. If someone was to be petulant about how they interpret the law, I don't believe that you would necessarily be able to utilize a test that happened prior to the offer itself under the strict reading of the law. not the practical reading of the law, but the strict reading. Other questions? Otherwise, an hour and a half, we're good to go. We've done our training. We learned things about ourselves along the way. Oh, HOA question. Which one was the HOA question? Would also like to see seller completes delivery of HOA documents, giving the buyer access to the HOA website to read all the information. On the HOA document itself, Melissa, there is a way to say how the seller delivers the HOA stuff, and it does have the option for like a USB or external digital file PDF sort of thing, or the website itself. So you can specify that within the HOA addendum itself, 4.4, the association addendum, but it's not nearly on the receipt thing. So I'll make a note of it. 4.4a, have a space for delivered with website, sort of like a checkbox on that. Melissa, if you are interested in the Forms Task Force, shoot an email to forms@oregonrealtors.org. It's an informal task force to some extent, so it's something that is not established with like a application process specifically, but just let us know. It's kind of a clown car. We have a lot of people involved at all times, but it's never a bad thing to have more voices.